Welcome to Professor FinTech. In today's video, we are diving into one of the most fundamental concepts of accounting: debit versus credits. Whether you are running a business or managing personal finances, understanding how these two terms work is essential. So let's break it down. In today's video, we will explore the concept of debits and credits and dive into the ADE and LDE matrices that help clarify these ideas. We will also discuss how debits and credit influence the increase or decrease of assets and liabilities. After understanding the concept, we will take you through examples to clear all your doubts. Let's get started. First thing first, what exactly are debits and credits? Simply put, they are the two sides of every financial transaction. Every time money moves, one account is debited and another is credited. That's how we keep everything balanced in the accounting. Every transaction will have two effects. One account will be debited and another account will be credited. Both account amounts should be equal. Example, let's say you buy a chocolate for $1. Here's how the transaction looks. You pay $1 in cash and you receive chocolate valued at $1. This transaction has two effects. Cash goes out while chocolate comes in. This is an example of debits versus credits. In accounting, what will be the entry for this transaction? Chocolate account debit to cash account. At its core, debits and credits are used to describe the movement of money between accounts. When you make a financial transaction, you need to record how that transaction impacts your assets, liabilities, or equity. But how do these work in practice? To help us understand debits and credits, let's look at two key accounting metrics, ADE and LER. To remember this, I have reshuffled the alphabets to present DEA, LER. DEA, LER is easy to remember as these initials create the word dealer. ADE stands for assets, dividends and expenses. It tracks the efficiency of how a company manages its assets. On the other hand, LER stands for liabilities, equity and revenue. It measures how well a company manages its liabilities. We will deep dive for the debit and credit to ensure that we will be able to post correctly any kind of a transaction that we come across in a day-to-day life or business. We should be able to classify them well, which falls under ADE side and which under LER side. This helps us to understand debits and credits. Let's look at two accounting metrics, ADE and LER. When we say that DEA will always have debit balances, if you want to increase the debit balances, you need to post more line items on the debit side. This will increase the debit balance. If you want to reduce the debit balance, you need to post entries to the credit side of the same account, which will reduce the balance from the debit balances. So why do we say that AD will always have a debit balance and DEA always LER will always have a credit balance? There is no logical reason for this. It is simply a rule. First, you need to classify where will it stand, DEA or LER side. Take the example of purchasing furniture with cash. In this case, two actions happen. Furniture increases and cash decreases. Now classify the correct entry to debit or credit. Furniture is an asset, right? Then this will fall under the DEA side, meaning an increase in assets will be posted to the debit balance. The next element is cash. Cash is also an asset, right? But is cash increasing or reducing? It's reducing as we paid to purchase furniture. This means this cash account will be credited to reduce assets. Hope you understood so far. If not, don't worry. We will dive deeper until you completely understand this concept. Now let's talk about increase and decrease in assets and liabilities. One of the most important aspects of accounting. When assets increases, it's a sign that a company's financial health is improving. But when they decrease, the opposite is true. Likewise, an increase in liabilities means more debt or obligations, which could signal deteriorating financial health. A decrease in liability is generally a good thing, as it means the company has fewer financial obligations. So how do we record these changes in accounting? Let's start with assets. An increase in asset is always recorded as a debit while a decrease is recorded as credit. This concept applies to all types of assets, including cash, accounts receivable, inventories, or properties. For example, if your business purchases a new piece of equipment, your assets go up, so you would debit the asset account. Now let's look at liabilities. Conversely, an increase in a liability is recorded as a credit, while a decrease in liability is recorded as a debit. Concept applies to all type of liabilities, including accounts payable, loans and bonds. For instance, if your business takes out a loan, your liability increases. So, you would credit the liability account. Here's a real world example. Let's say your company buys a vehicle for $10,000. That means now we will understand this example with three scenario. Scenario number 1, purchase on cash. When we purchase a vehicle with cash, we have two effects here, vehicle and cash. Both are assets. The vehicle is increasing the asset and cash is reducing asset. As a result, an asset increase will be on the debit side and asset reduction will be on a credit side. So the journal entry will be vehicle account debit and cash account credit. Scenario number 2, purchase on a bank loan. When we purchase a vehicle with a bank loan, we have two effects here, vehicle which is an asset and bank loan which is a liability. The vehicle is an increasing asset and the bank loan is an increasing liability. As a rule, an asset increase will be on the debit side and liability increase will be on the credit side. So the journal entry will be vehicle account debit and bank loan account credit. Scenario number 3, purchase on a credit. When we purchase a vehicle on a credit, we have two effects here, vehicle which is an asset and account payable which is a liability. The vehicle is an increasing asset and the account payable is an increasing liability. As a rule, an asset increase will be on the debit side and liability increase will be on the credit side. So the journal entry will be vehicle account debit and accounts payable account credit. So to sum it up, assets, dividends, expenses. Accounts are increased by debits and decreased by credits. LER, liabilities, equity, revenue. Accounts are increased by credits and decreased by debits. Now that you understand the basics of debits and credits, you are one step closer to mastering the world of accounting. Don't forget to subscribe for more insights on managing your business finances. Got any questions? Drop them in the comments and we will get back to you. Thank you.